Hello and welcome back to the ROI Club special guest podcast here today. We have the Unemployed Value Degen. I think he needs to change that now. It's the Entrepreneurial Value Degen. He's back from jury duty. He's been doing all sorts of things. And in his absence, while he's been locked up on jury duty, one or two things have been happening in the space, particularly the energy markets. So we're going to talk about the recent shellacking in offshore, and the juryman is going to decide whether offshore is or is not guilty. We're going to talk about New Fortress Energy. Always plenty to talk about their new earnings being released. We have a few themes. We've got the housing market apparently being unthawed over the course of the few weeks. He's got an idea for that. I've got an idea for that. And we've got the silver tsunami, where Steve has been, if there's one theme, mate, that you've nailed already significantly, I would say it's that. Welcome back to the podcast, Mr. Juryman. How are things?
Good. Being on the jury. Excuse me. Got a little bit of mate through the filter.
A little bit of whiskey in the mate.
Yeah, but being in the jury wasn't so bad. It was having my cell phone locked up from 9 to 5 while the market was open. I was a special kind of torture because the market's melting down. I'm using a little bit of leverage, and now I'm under penalty of contempt of court that my cell phone is in a little locker that I have a key to in my pocket.
So are you doing the calculations between the fine you'll get versus how much you stand to put the puts?
No. Fortunately, I wasn't using that much leverage. I toned it down from when I was younger. But no, it was kind of a local celebrity, a local gang celebrity. But the crime, but nobody knew until after the fact. But it was kind of like Al Capone's trial for tax evasion. It was totally unrelated to the gangland stuff, but it was a pretty popular guy if you're into St. Petersburg gangs and all the rap videos that they produce.
Okay. I guess I'm very uncultured now with you speaking about things that I have absolutely no idea. One thing I have been following in your absence is the energy markets, particularly offshore. The royalties, they're going well, so I'm happy. Offshore, curious case, we've had at one hell of a drawdown. Many of the companies are trading at or below their relisting price, with a completely new balance sheet, day rates $100,000 or more higher than where they were a couple of years ago. And so I put a post out on Twitter revising a Valaris thesis, and I said, well, either the market's retarded or I am. I'm buying more. So I've been buying more of this stuff. I don't know what your thoughts are, but I'd be keen to get them.
No, I think in small caps, when the momentum gets going, it gets pushed to just unreasonable situations. I mean, when I first found Transocean a couple years ago, I still believed the narrative that was being pushed by all these, NGOs with soft power that we're all going to be driving electric vehicles in a couple years. Until I listened to, I think it was Robert Friedland. He says, like, look, there's not enough nickel mines. You people are smoking something. There is not enough mining to get all these batteries. There is zero chance we're all going to be driving electric vehicles. There's no metal for it. And so the last time Transocean was trading with a 2 handle, I still thought we were all going to be driving electric vehicles within 5 years. And now that whole narrative is shifted. Everybody understands that we're going to be on oil for at least 20 or 30 years. I think everybody understands that now. And all the prices of these offshore drillers crashed to, Noble was below the price from when they went through bankruptcy.
That's correct.
And Transocean was almost at the price where I bought it a couple years ago. I never thought I would see those prices again. It's just, and that's why I'm a small cap value degen, because small caps are not a rational market. The momentum starts pushing them and they go way too far. And I'm just holding out. One of these days it'll go too far in the other direction. I have to hold on and not sell too early.
Yeah, exactly. I'm just sharing a screen here, guys. Rig down 40%, Noble 40%, Valaris 44%, and Bohr, as a pure play on jackups to get an idea between the two markets, down 61, we'll roll it up to 62% over the last 12 months. If you look at the RSI, it looks like we finally had a little uptick here. So there's something to cheer about. It looks like the bottom could be in. But this is truly insane. You say small caps, and that's true. Bohr is a bit of a small cap. But these guys were trading, $2 billion. They're still $2 billion companies. They were $4 billion companies. But it's not like it's a 20, 30, $50 million junior mining explore co that we're talking about here. And this is the sector. There's nothing really else in this sector. It's been consolidated and gone through I call it a bushfire, where you get rid of everything and whatever left is standing is it.
Yeah. Well, and they all traded together. There was no like, oh, this one has a better quality, this one pays a dividend. No, nothing saved them. They all traded together. So it probably was just, and as the big tech names are so big, the existence of these long short funds, if they have something to be long and something to be short, well, the Russell 2000 is so small. I mean, the Russell 2000 is smaller than pretty much any one of the Magnificent Seven. So if you have any volume in long short, and they want to be long big tech and short small value, there's just not that much small value to short, and that momentum. And even if these companies are undervalued, the higher big tech climbs to maintain that long short ratio in their portfolio, they're selling even more and more and more and more. So but at some point that will turn around, right? At some point the cash flow will overwhelm it. It'll turn around, and when it catches momentum and goes the other direction, you try and inflate that beach ball, the Russell 2000. How much air could it possibly take to blow a huge bubble in that thing? Because if long short flips the other way and they want to be long small value, it's such a small swimming pool. The long short money doing a cannonball in that tiny little swimming pool will be quite a thing to watch. But I don't know what year that's going to happen, but at some point, small value has to have its day.
That's true. I really think we need to wait until the ETF auto buy phenomenon starts to reverse, because the marginal buy, and you've got all this institutional capital that's squeezing towards a more and more narrow group of capital at the top. That when that unloads, whenever that is, are we going to see another brutal sell down? We might not have seen the worst of it. If that really is the dynamic driving this sort of thing, what's going to happen if that ETF bubble bursts, and that capital needs to find a home somewhere? So eventually it will start to push a bid, we think, under the value stocks. But we might be in for a few weeks of volatility before that rotation actually occurs.
Well, I don't think this is happening this week. As far as this particular drawdown, I think this drawdown might be getting close to the end. The way the market feels every day, the dip buyers are coming in, and some days the dip buyers are winning. I mean, it's not definitive, but I've even seen a few in individual names. I've seen a few really nice hammer candles, and it feels like that. It feels like the selling momentum is losing out, and the dip buyers are coming in. Maybe I'm the eternal optimist, but I think this sell off is running out of steam pretty fast here. As far as, I mean, having the American middle class trained to automatically buy equities every paycheck, every 2 weeks, every month, that is a very powerful force, especially with that home country bias, and now with the large cap bias buying the S&P 500. That is a very powerful force. And the S&P 493 isn't even that expensive. It's just the Mag 7. And the Mag 7 now, they're spending all this money. They're no longer capital light businesses because they're spending hundreds of billions of dollars on capex. So the return for the Mag 7 might be challenged, but that could still just be a flow into the other large cap stocks in the S&P 493. I don't know what it'll take for the middle class American to change their auto buying algorithm to include a little bit of mid caps, a little bit of small caps, a little bit of international. That would be quite a zeitgeist change to have everybody go into their automatic buying program and switch what they're automatically buying. I mean, that could be 10 or 20 years away.
Yeah, indeed. But I think the thing with it being a market cap weighted index, that's where you start to get this huge discrepancy. We have, the Magnificent Seven, eventually be the Mag Two, and then it'll be I don't know, the Wonderful One. Maybe Nvidia will be the last one to go there. And I think, that's why you mentioned the capex being spent by the Nvidias of the world in this AI arms race. That's where I've been spending most of my time, as you know, because I think that isn't changing anytime soon, and I want to be the guy at the other end of the capital flows. And it'd be interesting to see. We've got New Fortress coming out with some earnings. I was out dancing last night, so I didn't see the earnings report, but you did. So you can fill me in and see whether I'm still early or if I'm just plain wrong on New Fortress Energy.
No, I think it is early. I mean, it was early when I wrote about it when it was $25 a share. I I compared their recent earnings announcement with some of their past earnings announcement because I wanted to figure out, do they overstate, do they understate, do they end up beating, do they set themselves up to beat? Like if you look at last year, they were guiding toward 850 million of EBITDA, and they ended up with 950. So they have a pretty good history of trying to understate how things are going to be.
Yeah, they always sandbag.
And then they projected for $1 billion of EBITDA this year, but they also projected for $2 billion of asset sales. And they're prioritizing Jamaica. So they're taking their first market, their most mature market. So Jamaica's, I think it's pretty much entirely on natural gas, electricity at this point. So the only upside from Jamaica is organic economic growth. So you have this island that's entirely on natural gas, electricity pretty much. They've locked in a 20-year contract, and they have a 20-year purchase agreement for the natural gas. And it's essentially a 20-year bond that pays $125 million. So Jamaica for New Fortress Energy is just the 20-year, $125 million EBITDA a year instrument. And if you sell that at a 11% discount rate, that's $1.2 billion. If you sell that at a 8% discount rate, it's $1.7 billion. And this is like a utility, and utilities typically trade at a relatively low dividend. And they targeted, I think, $2 billion of asset sales this year. I don't know if that's just Jamaica alone, if they can get a 6.5% discount rate on a $125 million EBITDA for 20 years. That seems rich, but utilities could possibly do it. Especially, it's so rare to have your natural gas input cost fixed for 20 years. That's just an incredible setup to really lock in. No matter what happens in the world, you've got this totally controlled loop of $125 million a year for 20 years. And meanwhile, the other markets where there's room to grow, they want to hold on to those and grow into them. So that's if you take the asset sale and you take off that $125 million of EBITDA from Jamaica, I think their $1 billion projection for EBITDA for 2023, I think that already has Jamaica removed from it, because I compared their old presentations for Nicaragua coming online this year, Barcarena coming online this year, and they had projected, 1.3 billion-ish. So I think they've already taken out the Jamaica EBITDA from their projections, and I think they're also underestimating a little bit. But the big development for New Fortress Energy, which is so amazing, is that Puerto Rico just got their first Republican governor in Puerto Rico's history.
Yes, I did see
So,
that.
friend of Donald Trump wins the governorship in Puerto Rico, and in her speech, her victory speech, in like minute 5, she talks about getting the island on natural gas electricity and lowering the cost of electricity. So this is a major campaign platform. And then Puerto Rico announced a new build power plant that Puerto Rico is going to build. That's going to come online in 2028. New Fortress Energy is going to supply the power until 2048. So 20-year contract, $100 million a year for 20 years. Again, that's just, and now that they've paid the capex up front for the import terminal, that's almost a zero cost, $100 million EBITDA for 20 years. And Puerto Rico has low-hanging fruit. There's 4 power plants that can be switched. So without building a new one, just switch the fuel type from diesel to natural gas. And some require a little bit of equipment installed. Some require almost nothing. They can be switched at the drop of a hat. And then the question is, if New Fortress Energy pays for the conversion, can they get a 10-year contract, a 15-year contract, a 20-year contract? And also the other contract that New Fortress Energy currently has, it only goes until March of 2026. And under this new governor, Puerto Rico wants to do a new tender for a 10 or 15-year contract for that delivery. And then it'll be a competitive rate. Other people will be able to bid on it. But who would be able to deliver without using New Fortress Energy's infrastructure? So either they get sort of an advantage on it, or if somebody else wins, do they have to rent their equipment, or how it would work? It's kind of New Fortress Energy is shoe in to win it. We don't know at what kind of margins. I don't know if they're going to lock in another 15 years of $7 in MMBTU. Normally, when they build the equipment themselves, they lock in that. In Brazil, it was a 25-year contract in Barcarena, which is fantastic. Because Puerto Rico was being done with this Army Corps of Engineer FEMA situation, they didn't start out with this 20-year contract. So it's going to be curious to see how New Fortress Energy maneuvers down there. But they built up a lot of goodwill. So they voluntarily renegotiated a contract that the politicians in Puerto Rico didn't like. They had this incentive fee, and they pretty much just, said, hey, you don't like this, okay, we'll cancel it. That was like $100 million a year for 10 years that they just gave up. And it's not clear what they got in exchange for giving that up. If it was just goodwill towards, I think they're going to announce some power plant conversions really soon that is very low capex, very fast, that they have the capacity to deliver. They have the ships, they have the natural gas to deliver. They built a power plant in 28 days. They can convert one at that drop of a hat because those power plants already can burn natural gas. They just really need the hookup. So I think Puerto Rico now is a huge opportunity. I'm not exactly sure what the asset sales are that are going to raise $2 billion. I think that they were going to sell half of the southern Brazil asset on the Brazilian stock market. I don't know if they're still going to do that because the Brazilian stock market has kind of tanked with the real. So I don't know if they're going to delay that plan. I mean, they don't have any near-term maturities that are really that painful, so they can wait. They might as well wait for higher prices. And I think they might have been waiting for higher prices because interest rates are coming down now. So I said that, sale of the Jamaica asset for who knows how much, that's a lot better if the 10-year treasury comes down by a point between now and then.
Okay, so we don't have a final sale price for Jamaica. What would make it a good sale if you were to use that 100 million? What's a good price to get for that? Given that it was
I was under the impression that the things like this, they wanted to like sell half and keep half, and also still manage it and still maintain it for maybe some sort of a management fee. And it's not like they wanted to sell it to a competitor that's also in the natural gas space. They probably want to sell the cash flow stream to something like a pension fund that has the cash and doesn't want to compete with them. So I think it's not like they're going to go sell it to Golar LNG. They want to sell it to, the Kentucky Teachers Pension Fund and say, hey, would you like to buy $75 million a year for 20 years for your teachers to retire? And then also they can charge a little bit of a management fee on top of that because they're taking care of the thing for them. If they were to sell the whole thing, I think an 8% discount rate's not unreasonable. That's $1.7 billion for Jamaica. I think it's much more likely that they'll try and get something less than that and not sell the whole thing. And I don't know if they're going to continue when the Brazilian stock market is so weak to do a Brazilian IPO of that asset there. It doesn't make too much sense. And then another thing was they have the ability as interest rates come down to refinance some of their debt. They talked about this before, which is doing an asset-based loan. So their FLNG, their floating liquefaction facility, they said that can handle $1 billion of debt. So equipment leases are some of the lowest interest rate leases out there because somebody can come and seize the equipment. It's mobile collateral. So if they could get a 5% on $1 billion and replace a 12%, that goes a long way too towards lowering their interest expense.
Yes, considering that how it came to be that they achieved that 12% interest rate. But anyway, we won't dwell on the past. Wes seems to have steadied the ship here, and we've got some line of sight. So all things looking pretty good for New Fortress Energy. Next question is, Stephen, what's it got to do to catch a bid?
The entire energy space, and this is something that so they manage their derivatives. They don't even have any exposure to natural gas prices.
People just don't understand that. They do not understand that about this company.
So they had excess capacity and they immediately went out and sold some derivatives on it to remove the natural gas price exposure, especially while Dutch TTF prices in Europe are so high. So they've kind of locked in some nice prices on their excess liquefaction capacity while they're waiting for Brazil to come online. But they maintain a default of no natural gas exposure, so it really is these, because Wes Edens he's a bond guy. He likes those, explain it to him in terms of $100 million a year for 20 years, and he can value that bond. And that's what New Fortress Energy is doing. But the entire energy space can't catch a bid. And it's bizarre because the narrative has changed. Everybody understands that we're not going to be on electric vehicles by 2030 or by 2035. That narrative that was being pushed by soft power, by people who just wanted to manifest it into being without realizing that we didn't have the metals to do it, that's gone. So with that narrative gone, I understand that energy was kind of weak. Energy was weak during the Biden economy while we had, 3% GDP growth. But that 3% GDP growth under Biden was government employees who were working from home and hospital medical administrative staff, which is also, pseudo government. All the job growth, all the economic growth was
Non-market.
government jobs and people working from home. If you have any growth in the real economy that requires, trucks moving and planes flying and ships shipping, I
Energy
think,
to
yeah,
manufacturing, the whole.
yeah. So I think energy is, if we actually have growth in the real economy, the energy is not prepared to respond. And I think people are kind of complacent because they said, oh, well, we had 3% economic growth and energy didn't do anything. Well, that was with the economic growth in government employees that were working from home. And now they're getting purged, they're getting fired, they have to return to the office. And you have the destocking cycle turning around and trucks are moving again and, manufacturing on the way up. So if I personally don't think we're headed into some giant global economic recession. I think we're early cycle and heading into an expansion because you've got China coming out of their version of the Great Depression from their apartment overbuilding and switching to manufacturing automobiles. And you've got the United States that I think there's a good chance that if you go back and look at the data without all the government adjustments to it, in 2024, when consumer spending fell off a cliff that summer, I think we probably went through some kind of a recession and we're coming out of it now. Because all of the companies I listened to on earnings calls, they all had this consumer cliff where the consumer just kind of gave up right around the springtime in 2024, and they were just not buying. And that to me sounded like some kind of a shallow recession that we're coming out of now, and it's going to be off to the races. So I think people aren't ready for it. I think if you see energy demand pick up, and the storage, we're at the bottom of the tank barrels, right? We're scraping the bottom of the barrel for energy storage, and prices of energy keep falling. It's crazy stuff. Welcome to Crazy Town.
Yeah, exactly. I was going to mention that right as this turnaround's happening on the demand side, the supply side, as you mentioned, inventories are at record low levels over 5-year average, and we've got no strategic petroleum reserve really to draw upon. That's all on the fuel transit side of things. I'm just simply thinking from an electricity point of view now, where you've got this huge growth in data centers and AI, and you've seen this being reflected in natural gas. So natural gas, I think US natural gas molecules, I've said it before in the past, I'll say it again, I think they're going to be the most sought after source of BTUs over the next 2 to 3 years until some sort of or longer, until some sort of a nuclear rollout can happen. That's steady state demand. That has very little to do with the transit side of things. And I think that's where people are going to get caught out. And I don't know how he's done it, but I think that's where Wes has been way ahead of his time, securing the cheap natural gas at contractual prices and locking in a spread. I'm still a fan so far. I'm long and strong NFE. With the market turnaround, let's talk about the US real estate market that I'm told is gonna thaw. Stephen, how's it gonna thaw? Nicely, or is it gonna be like chicken that you leave out on the window and you forget about, and it's gonna be a bit nasty?
Yeah. I mean,
Because
the
if the US
Treasury
housing market
Secretary.
thaws, brokers are way too cheap. Douglas Elliman that you spoke about, way too cheap. Remax, just for the average Joe, way too cheap. And all that's going to lead to more consumer spending, right?
Yeah. I was so shocked when I saw the new Treasury Secretary, Scott Bessent, say that he thinks the housing market was going to thaw in a few weeks. Like he thinks the housing market. So now I'm accustomed to politicians, fibbing, trying to manifest reality, trying to jawbone the market. So he might be trying to make things happen, but he doesn't strike me as a traditional politician. He does strike me as somebody that has a pretty good understanding of currencies and interest rates, since he was the guy who was the team lead under George Soros to break the Bank of England in the 1990s. So he knows something about currencies and interest rates. And Scott Bessent says the housing market is going to unthaw in a few weeks. So he could just be a politician who's trying to jawbone the market. But you saw Druckenmiller. He was saying that the Treasury short was in the 7th inning, and that was already a few weeks ago. So the U.S. Treasury's rates falling, there's a lot of short covering. I don't know how many shorts are left to cover. But if the 10-year Treasury gets down to about 3.5%, I don't know if I saw this somewhere else. That was kind of their goal. I don't know if Scott Bessent said that or people are just inferring it. But a 10-year Treasury at 3.5%, and then a 30-year mortgage spread around 2%, that would be a 5.5% 30-year mortgage. I think at a 5.5% 30-year mortgage, the housing market would unthaw. To get the mortgage spread down from 2.5% to 2%, they could do that one of two ways. So there's some regulations that were put in place after the global financial crisis of 2008 that added about half a percentage point of cost to mortgage underwriting. So if they roll back a bunch of regulations, I'm not saying this is a good idea. I'm not saying we should blow another housing bubble. I'm just saying that if Trump really wants to get that 5.5% 30-year mortgage, you could get a 0.5% off the mortgage rate by deregulating, or the Federal Reserve is still letting assets roll off their balance sheet. We're still quantitative tightening, right? We went through that consumer falling off a cliff through 2024, and the Federal Reserve Bank is still tightening their balance sheet. So even if everybody's focused on how many interest rate cuts is the Fed going to do, I think the big change is they could stop quantitative tightening. And that language was in the minutes that were last released, that they're talking about ending quantitative tightening. Now, I don't know if they're going to stop the quantitative tightening on the mortgage-backed securities. Right? If they could just keep on letting mortgage-backed securities roll off the balance sheet, but replace them with treasury buying, that would lower the treasury, but it wouldn't close the gap on the mortgage spread. But if they go from being a net seller of mortgage-backed securities to just flat on mortgage-backed securities, which means they would be buying some mortgage-backed securities, which is illegal. They're not supposed to buy that stuff, but nobody cared when they did it anyway. So you could get 0.5% off of the mortgage spread, either by ending quantitative tightening or by deregulating. And either one of those things is, within Trump's understanding, within Scott Bessent's understanding. Like, they know that those are out there, that they could do that. So I think the odds of getting a 5.5% 30-year treasury, or even maybe a tiny bit lower, is pretty good. Or sorry, 30-year mortgage. 5.5% 30-year mortgage. 3.5%.
Here we're having a very different conversation.
Yeah. So 3.5% 10-year treasury, 5.5% 30-year mortgage. I think those odds are good. And if that happens, now, I don't know that the housing market will unthaw that quickly, because local governments keep on, every couple years, they raise the millage rate. They keep increasing your property taxes. So, and when interest rates were zero, the housing size, the footprint, the square footage for a house skyrocketed under zero interest rates. So there's a lot of 3,000 square foot homes and if they were sold on the market at current prices, the tax burden on that thing for the local government would be devastating. So between taxes and insurance, even at a lower mortgage rate, there's a lot of 3,000 square foot homes that just cannot be sold. That the 60-year-olds living there, they're going to stay put. They're stuck because they have no one to sell it to. Which brings me to my Finance of America company thesis. But the ability for anybody younger than that to take out a home equity loan is going to be pretty good. And Rocket Companies is one of the leaders, I think, in home equity loan. They've taken a lot of market share over that during this downturn. During the leading up to the global financial crisis, there was a lot of cash out refinancing. Right, people that had a 6% mortgage could, though, refinance that to a 3% mortgage, take $100,000 out of their house, and have a smaller monthly payment. That's not going to be on the table for most people, because most mortgages are still under 4%, and nobody's going to be able to refinance down. But you could add a $50,000, $60,000, $100,000 home equity loan on top of that at 5.5%, and then go buy a jet ski, go on a trip, buy a Winnebago, buy a Harley Davidson, whatever you want to do, buy a timeshare, live it up a little. So I think that a home equity loan, or Finance of America through their refinancing, so Rocket through home equity loans or Finance of America through refinancing, I think are really, reverse mortgages are kind of the big beneficiaries of these lower interest rates.
The dollar won't be. Maybe that's why we've got a crypto strategic reserve and a Bitcoin strategic reserve in the works. And it would fit your thesis last time, where we spoke around the DXY and expecting a rollover at some point during the year. Likely that will have to roll over. Depends on, well, maybe not if the Europeans insist on financing a bit of a dust up.
Yeah,
maybe.
the dollar could end up staying strong
Mm.
because Europe is going full into deficit deficit warfare, welfare, guns and butter on what kind of a workforce, on an aging workforce, and a welfare state that doesn't have young people to prop it up. So as other countries have interest rates that are lower than the U.S., it's harder and harder for the dollar to weaken. Australia still has a very modest interest rate. Canada and Europe have slashed theirs. They're more than a full percentage point lower than the US on the overnight bank rate. But the UK and Australia are being relatively prudent, at least compared to Canada and Europe. But we'll see. Australia just cut theirs. So Australia is in a cutting cycle. The UK, who knows, because they're a clown show, if they're going to be able to keep cutting or if their bond market is going to revolt. But the United States, this is why I don't know if the United States is going to keep on cutting as aggressively. If they just end quantitative tightening, it does a lot of work. But the rest of the developed world, except Japan's raising their interest rates, but they're kind of odd man out every time. Everyone else is cutting pretty aggressively. So the dollar could stay strong, which makes it hard to create an export economy. What are you going to do?
Well, yeah, it's interesting. We've got way too much private debt here. We've got private debt to GDP levels where Japan was towards the end of the 80s. So that's really saying something. You and I, maybe we'll start a PE fund, mate, and we'll leverage cheap European loans and we'll buy up some stuff in Europe. And because you can get fixed mortgage, if you're a citizen, you can get fixed mortgages over 30 years, and they're actually now cheaper than the variable rate, if you can believe that. So that's something I'm working on in the background. Silver, Tsunami, you alluded to Finance of America, and Jackson Financial is another one that you've spoken about. Finance of America has done really, really well price-wise, but if you look at what it's got in the works in terms of a backlog versus its current market cap, still looks pretty cheap. Where are we at in terms of Finance of America?
And the yield curve just reinverted. And the yield curve being inverted is what just fills their bags full of cash. And the yield curve just reinverted again. And this, as long as and it could invert even more. So if we get a 3.5% 10-year treasury, while Jerome Powell's still sitting on a 4.25% overnight rate, that's a big inverted yield curve, which I have, for those that are watching, I have a paywalled write-up on my Substack about why the inverted yield curve benefits Finance of America companies. It's a little off in the weeds. I don't want to spend too much time talking about it because it's, but I didn't think we'd see the yield curve reinvert, and then here we are with an inverted yield curve again. So, but I guess the thing about Finance of America, or the thing about the United States generally, so you talked about how the private debt in Australia and Canada is outrageous, not in the United States, because the United States incomes grew, and everywhere else the incomes didn't really grow and the debt grew, because especially Canada, they didn't have the housing market crash when the United States had a housing market crash. Their houses stayed expensive. Well, people that bought houses took out giant mortgages, and now the debt is outrageous. So in the United States, incomes grew compared to the housing debt. And in Canada and Australia, they really didn't so much. So the United States, the middle class, has something like $150 trillion of assets. That is an enormous pile of money. A giant chunk of that is in their home equity, which if we don't have some massive housing crash, it's probably not on the table for that to be affected. They've got, a huge chunk of money in bonds, a huge chunk of money in stocks, a chunk of money in life insurance policies, a chunk of money in traditional pensions, and a chunk of money in their primary residence. But that's $150 trillion. And what's the whole market cap of the German stock market? 4 trillion, 6 trillion. If you add up Germany and Japan's stock market, I think you add South Korea's on there too, you get something less than the home equity that senior citizens in the United States own. Senior citizens in the US have, I think, 15 trillion in assets. You add up Germany, Japan, and South Korea's stock market together, you fall short of that.
Wow. Okay. And so at least some of that's going to go into reverse mortgages, because if you're retiring, where are you going to go? You're not going to sell your house necessarily, and you're not going to have enough in bonds because that whole thing, that trade is over for quite some time. So you're going to need steady state paychecks, and the main asset that you've got, as your work shows, is your home residence. And you mentioned life insurance, and you've got a beautiful discovery in that section. You can talk about it if you want, but if people need to pay for it, they absolutely should. So I'm going to refer people to your Substack. There's an idea there that I have bought into. As soon as I read it, I got it, and I really, really like it. Maybe you can talk about the theme more generally, and if it piques people's interest, they can find out the specific way to play it via your
Yeah.
Substack.
So and we've got Jackson Financial. They're the market leader in variable annuities. We've got Finance of America companies. They're the market leader in reverse mortgages. In life insurance, kind of like variable annuities. So if you take out a life insurance policy, the reason people do it, the primary reason for life insurance is if something happens to the breadwinner, they want the mortgage to be paid off. And if they're posh enough, a pile of money for their kids to go to college. So they say, okay, I want this amount of payout. That's enough to pay off the mortgage and send my kids to college. So they'll start that policy in their fees. And then if there's, most of the time people are long lived enough, they've been paying this monthly premium and their kids have graduated college. And they say, well, why do I need $1 million life insurance policy anymore? Why am I still paying for this thing every month? The whole purpose of it was to pay off the house and send my kids to college. Now I'm 55, the house is paid off, and the kids are done with college. So what do I need this $1 million life insurance policy for? Well, they have some value in that life insurance policy based on the price that they locked in and how much they've been paying all along. So that life insurance policy has a residual value, but the people don't really want to keep paying the monthly payment. And on top of that, the baby boomer generation specifically, and I'm not trying, enough people criticize them. I've got a lot of family members that are baby boomers, and I'm not trying to dunk on them so much, but they are referred to as the selfish generation. About half of baby boomers don't believe in inheritance. They say, look, I paid for college, my kids are on their own. And that is pretty fair. I mean, college is expensive. College is like an early inheritance. If you spend, $200,000 sending someone through college, I think their conscience is pretty clean there. So they have this $1 million life insurance policy, and they don't even believe in inheritance anymore. If they go back to the life insurance company, they give you a surrender value. That surrender value is peanuts. There's a handful of companies that will buy that life insurance policy from you, and they'll pay the payments until you pass away. So now it's out of your mind. What those companies will pay compared to the life insurance surrender value is about 8 times. And this is a very unknown marketplace. They do some advertising alongside Jackson Financial's variable annuities because most consumers don't know about it. They just think, oh, I've got to go to my life insurance company and accept the surrender value. Meanwhile, there's a company that'll pay you 8 times that because that contract has value in the secondhand market. There's only really one large player in that marketplace, and it's a 20-year overnight success story that's still founder-led, still majority owned by its 3 or 4 co-founders. So it's got great incentive alignment. They're the public market leader in that space. And they just did a couple of acquisitions as a roll-up, and now they have, they went from US only to having access to the global market through Luxembourg. So I've got that paywalled right up on my Substack, but that's my triumvirate for the silver tsunami is the market leader in variable annuities, the market leader in reverse mortgages, and this market leader in buying out life insurance policies.
So I like it. I like it a lot. So if these guys are buying these policies at 8 times their residual value, how are they making money? How are they selling this thing?
So the vast majority of the time, they go back to the life insurance policy as somebody who knows what it's worth, and they immediately get paid a 20% premium over what they bought it for. So that's what happens most of the time. If it's a policy that's particularly attractive, and they have this, after 20 years, they have this huge proprietary data set on how long people are going to live. And they have a biotech partnership. They're trying to, do a blood test, do a genetic test, and maybe even more accurately predict how long you're going to live. If they have a particularly nice life insurance policy, they might just hold it on their books. That's only about 10% of the time. And then another chunk of the time, they'll take this bundle of assets and go to a pension fund and say, hey, would you like to buy this and we'll manage it for you? So most of the time, they just negotiate with the life insurance life insurance company themselves will immediately buy it at a 20% premium. Another chunk of the time, they'll find a pension fund who wants to own a bunch of this stuff, and then they'll manage it for them for a portfolio management fee. And then sometimes they'll just hold it on their books until, the person expires.
No, I like it. It's very funny the way that you describe it. It's, in my mind, analogous to New Fortress Energy in some ways. locking in that spread, just in a very, very different sector or application to the same idea. I love it. I love it a lot. Guys, check out the Substack. You'll be able to read in detail this particular idea. So Jackson Financial over 1 year is up 41%. On what I call the quick and dirty overview, it still looks ridiculously cheap, mate. It's gap earnings, 4 times gap earnings. We're looking at 12.5% market cap to free cash flow yield, 2/3 price to book. How much has this thing got to run? And then Finance of America is at 200 odd million in market cap. It just went up 8% overnight, but it's still got how much of that $1 billion windfall due to come in over the next 3 years?
So Finance of America companies, I just made a video for about Jackson Financial on my Substack, modeling an exit price. And most financial firms of their quality traded a price to earnings ratio of 15. And Jackson Financial is trading at a price to earnings ratio of 4.5. So it's still a triple on multiple re-rating alone. And they're buying back stock so aggressively. This company, I'd have to pull up my spreadsheet. I think they've gone from 94 million shares to 76 million shares since 2021. I mean, so this is just an aggressive share buyback machine at the moment. They're paying a dividend, and the dividend's been increasing, but the dividend's been increasing because they're spending the same amount of money every year on the dividend, and they keep shrinking the float. So they're not spending more money on the dividend. It's grown from 50 cents a quarter to 80 cents a quarter just on the float reduction, not on them spending any more money on the dividend. So it's pretty amazing. So this is a company that if it takes 5 years for the re-rating to come, that's 5 more years of the float shrinking. And I've got a long video, because I can talk forever, modeling the exit price on, how long does it take for the multiple re-rating. If it's a triple just on multiples, plus the company is growing because the silver tsunami is happening and they're the market leader in sales in their category, and then they're buying back stock, it would be a pretty nice to 4 or 5x in 4 or 5 years, or maybe it takes 10 years to triple on a multiple re-rating, but that's 10 more years of aggressive share buybacks. And then
it's such a safe sector.
And because all they have to do, they've got $330 billion of assets under management. Nobody ever surrenders these things because you just have to take whatever Jackson Financial would give you. People don't surrender variable annuities very often because the people that bought them are the kind of people that really need a life insurance company to guarantee. They need that guarantee to sleep soundly at night. They don't want to take risks. And if you surrender your contract, you get whatever they offer you, which is peanuts. So almost these things are very, very rarely ever surrendered. So it's $330 billion of assets under management that even if they didn't sell new policies, they'll be earning off of that for a very, very long time. But if you want to hold Jackson Financial for the long run, at some point when the silver tsunami is over, and they're not selling so many new policies, right now their payout ratio is about 45% because they have to take some of that money and they have to use it for their statutory requirements for loss reserves. When you get to the point where they're sending people more money back every month as they're living off of their annuities in their old age, and they're not selling as many new policies, I think you'll see a world where the payout ratio goes over 100% because they can start winding down these statutory requirements. So I think right now, last year they did 1.4 billion in net income, and I'm using their own adjusted figures because you can use the GAAP figures don't work very well with mark-to-market derivative losses. I think if you look 10 years in the future, you'll see a year where Jackson Financial has $2 billion of net income and returns $3 billion to shareholders because they'll be above 100% payout ratio because they'll be winding down all these loss reserves that they have to have statutorily. And that's, for a $7 or a $6 billion company to be maybe 10 years away from a year where they return $3 billion to shareholders is pretty exciting.
Yeah, absolutely it is. Finance of America.
So Finance of America companies, again, there's this pretty complicated mechanism with the inverted yield curve. You can read about it on my Substack. But they do have, so they were the 20% market share leader, and they acquired the 17% market share, second place, to become a 37% market share company. But when they did that, the stock price was so low that the company they acquired, they paid them a huge amount of stock. but they didn't want to give them voting rights. So they didn't give them common stock. They gave them these LLC units. So there's this non-voting minority interest. So the float you see isn't the fully diluted float. I think it's closer to a 500 million market cap, even though it only shows 200 million. So, there is some math there that I don't think I have on my Substack for the convertible debt and this LLC unit. So think of it as a $500 million company. But with their $7 billion portfolio of non-conforming mortgages that they were earning a 4.8% spread on for a couple of years, I think they've got between 700 million to $1 billion coming to them in the next 2 years as some of these mortgage-backed securities mature. That's going to start showing up. The very first one matures in April. Now, this exact upcoming earnings call, I think, is kind of dangerous because interest rates were rising into it, and I think there might be a mark-to-market effect. So I would not be surprised, for anybody who wants to run out and buy the company today, I wouldn't be surprised if there was a bad mark-to-market consequence on this upcoming earnings call, but I'm not guaranteeing it. So I'm not buying any or selling any right now. It's a 9% position for me. It could crash, and their earnings call is on the 11th, which is in 4 days. So it could crash on earnings. It could also skyrocket on earnings because they have the mark-to-market effect that when the mortgage-backed securities become only 1 year remaining on their 5-year term, they start adding that to book value. Last quarter, they added $170 million to book value on a 200 million market cap company. Well, 500 million fully diluted market cap company. So you could have a surprise of another couple hundred million added to book value, or you could have a surprise where the rising interest rates into last quarter causes some mark-to-market losses on their $26 billion portfolio. So this upcoming earnings call is dangerous, but the long-run thesis is that they've already earned $700 million in cash, and it's just to arrive coming up. And then they've also flipped to operational net income positive, because when the banking crisis happened with Silicon Valley Bank and First Republic Bank, these reverse mortgages, these are intimidating contracts to sign. This is a hard sale. And when there's a banking crisis, these 70-year-olds at home watching Fox News or MSNBC, they get scared and they're, cowering under their Afghans, right? So they don't go and engage in some very intimidating contract. But now that we're far enough away from that banking crisis, their sales volume is up to, I think they did 500 million last quarter, and they're projecting 500 million this quarter in nominal value of these reverse mortgages. And that's enough volume for them to be operationally net income positive. And that was part of the big price spike from $5 to $30, is that, hey, we're not losing money anymore. They're actually making money operationally. So I can't guarantee a sell-off on this next earnings call. I'm just aware it's a possibility. So don't come at me if it happens. But it also could just keep on grinding higher.
Yeah, okay. Yeah, that quarterly earnings will be retrospective in nature. So, it could make sense. We'll see what happens. Here's one for you. One thing it's not directly related to the silver tsunami, but it does, I would say, if your silver tsunami thesis and my land thesis had a baby, it would be the St. Joe Co. Where are we at with Joe? I like it more and more every time it takes a bit to get your head around, but once you do, I think it's a perfect play between your thesis on the silver tsunami and my thesis around land.
Yeah. Well, what's amazing is on the last quarterly earnings call, even though most of the country real estate transactions were kind of frozen, not at the beach in Florida, right? They had a pretty good real estate sales last quarter. So this is a huge land bank. This was it used to be the St. Joe Paper Company. So used to be a huge amount of forest land for a paper mill that like 100 years ago, this was an army base that was acquired by this paper company. And now it's just a huge land bank in Florida on the Panhandle. And the Panhandle of Florida is one of those last underdeveloped areas where it hasn't turned into Fort Lauderdale. And it's on its way to becoming, if you zoom out 30 years from now, it's going to look like Fort Lauderdale or Fort Myers or Boca Raton. So you know that this beachfront property is going to be built up 30 years from now. In the meantime, St. Joe is being very, very smart about how they develop it. So they have their hospitality, they have hotels, they have resorts. What they're doing is they're for every single family home they sell as a real estate developer, they take that money and they develop the commercial themselves, and they never ever ever sell the commercial. They keep the commercial real estate to collect rent on it, escalating rent, beachfront forever. And they do the single family home development to fund that. And I think that's the smart way, because that's what the Chinese tycoons did in the Philippines. I think that is the way a tycoon would play the situation if you had a giant tract of land, is you use the single family home development to fund the development of the commercial, and you never ever ever sell the commercial. You just keep escalating commercial rents forever, and you're a monopolistic landlord on a huge tract of land on the beach in Florida. It's not just some of it is close to the beach, but they also have this huge intercoastal waterway. So it's on kind of a lake near the beach in the panhandle of Florida. Earlier on in Florida's development, people were driving down Interstate 95 from Massachusetts and New Jersey down the east coast of Florida. There is a new wave of migration coming from Illinois, Indiana, Ohio, Michigan, Wisconsin. They're coming down I-75, and they're arriving on the west coast of Florida in the Panhandle. And so this is, and you just massive migration to Florida. Florida's getting over 1,000 people a day moving here. And that's where things are still relatively affordable if you want to live near the beach and you don't want to pay Fort Myers or Fort Lauderdale prices. So, I mean, I think everybody knows in 30 years it's going to be massively developed. And in the meantime, on a lot of metrics, St. Joe doesn't look cheap. But I think last quarter or 2 quarters ago, they built a new hospital. Well, when you own, they have 150,000 acres of this property. They've set, I think, 50,000 of those acres aside to be, undeveloped forest property to kind of increase the value of the rest of it. And it's kind of arguable about 20 years after their master plan is done, will they ever get access? Will they ever be able to reclaim that and develop it or something like that? But so call it 100,000 acres of beachfront property. Building that one hospital makes the other 99,000 acres much more valuable, because now it has proximity to the beach and a hospital. And that doesn't show up in the book value, because the book value is what they paid for the land 80 years ago. So the book value doesn't really show the value of the company. And every time they build a hotel, they build a golf course, they build a hospital, they build a shopping mall, all those amenities make the rest of the land more valuable. And so you don't really see that right away. This is what some of the big philanthropists did. So if you look at the philanthropists that donated a university, you look at places like Vanderbilt. Well, what they donated to the university was the hole in a donut of land that they owned. And the increase in value to the rest of the land from having a university in the middle of it, they ended up making money off of creating a university. So you look at some of these original philanthropic tycoon land grant universities from the great industrialists, they made an awful lot of money by giving away the donut hole in the middle of the donut from their land holdings. And it's the same thing with St. Joe. They build a hospital, all the land becomes more valuable. They build a shopping mall, all the land becomes more valuable. If I saw that they gave away 3 acres to build a university in the middle of it, again, all the land would just become more valuable. So it's a 30-year story. I bought some into my wife's Roth IRA. The market sold off, I think, on the retirement of the chairman and controlling shareholder, Bruce Berkowitz. But it's not like he's gone away, right? He still has his hand-picked executive team in place, and they're still executing his vision. He's just old and retired, but he hasn't sold his shares, right? He's still in control of the thing.
Very, very interesting story. We'll be keeping an eye on it. Mentioning Florida, I'm going to be there in July, guys. So if you're going to be around Boca Raton, Steve's going to get a leave pass. So he's got to be a good boy on his best behavior between now and July, so that the boys can go to Boca. Uncle Rick's hosting. And so make sure you drop in. Link will be in the description if you want to attend in person or online. If you attend in person, come and say g'day, and we'll have some fun in Florida. My friend, in order for you to get that leave pass, I've got to let you go. Otherwise, you'll be in trouble with Mrs. Degen. So we're going to wrap it up, guys. Make sure you check out Steve's Substack. It is got to be up there with the best deep value Substack on the internet. And I look forward to catching up with you in another episode of the ROI Club then. Take care, guys.